If you believe buying a $500,000 house automatically means you are winning financially, the next few minutes might completely change how you think about one of the biggest decisions most people will ever make in their entire financial life. Picture this moment clearly in your mind, because it is a moment millions of people experience every year when they sit across from a lender who just finished reviewing their application and suddenly hear the words that seem to confirm everything is going well financially. Congratulations, you're approved. In that instant, it feels like proof that your income is strong, your financial situation is stable, and your future is secure enough for a bank to trust you with $500,000 tied to a single asset called your home. The excitement is real, the keys feel heavier in your hand than you expected, and the house suddenly feels like a symbol that you are moving forward in life, exactly the way responsible adults are supposed to. But hidden inside that exciting moment is a quiet truth that rarely gets explained during the home buying process, and that truth is that mortgage approval answers a very different question than the one most buyers think it answers, because the bank is not asking whether the house will help your finances grow. The bank is not asking whether the payment will limit your investing, and the bank is definitely not asking whether your future lifestyle will feel financially comfortable. The only thing the lender is calculating is whether you can technically survive the payment every single month without defaulting on the loan, and that difference between surviving a payment and comfortably living with a payment may quietly shape the next 20 years of your financial life in ways that most people never notice until it is already happening. A $500,000 home can look completely reasonable when you are sitting at the closing table, because the lender runs the numbers using ratios that appear mathematically responsible. Your income fits inside the guidelines, your credit profile satisfies the requirements, your debt-to-income ratio falls within the acceptable limits that banks use to measure risk, and because everything aligns perfectly inside those formulas, the mortgage becomes approved and the house officially becomes yours. But approval does not automatically mean the decision supports the rest of your financial life. Once normal life begins again after the excitement of moving in, because when the boxes are unpacked, when the furniture is ranged, and when the monthly bills begin arriving one by one, many homeowners start noticing something subtle but powerful happening inside their finances. Their money stops expanding the way they once imagined it would. When they first began building their financial future, savings accounts begin growing slower than expected even though their income has not changed. Investment contributions start shrinking month after month, because the mortgage payment quietly absorbs more cash flow than they anticipated during the buying process. Emergency expenses begin feeling heavier than they once did because the financial cushion that used to exist between income and spending slowly disappears over time. At first, the change is so gradual that it almost feels invisible, because nothing dramatic happens during the first few months of owning the home. But over several years, the pattern becomes clear as the household realizes that more and more of their income is permanently committed to the structure they live in. The house that once symbolized financial success slowly becomes the reason financial flexibility begins disappearing from everyday life. And the surprising part is that nothing went technically wrong during the buying process, because the mortgage approval was calculated exactly the way the lending system was designed to calculate it. Mortgage lenders evaluate affordability using standardized financial ratios that exist primarily to measure risk for the bank rather than comfort for the homeowner. One of those measurements is called the front-end ratio, which estimates how much of your income goes toward housing costs like the mortgage payment, property taxes, and insurance. Another measurement is the debt-to-income ratio, which evaluates how much of your income goes toward all debt obligations combined, including the mortgage, car loans, student loans, and credit cards. Depending on the loan program, lenders often allow housing expenses to reach roughly 28% of gross income. Total debt obligations may climb somewhere between 36 and 43% of gross income before the loan becomes too risky for the bank to approve. At first glance, these numbers appear responsible and balanced because they give the impression that a significant portion of your income remains available for everything else in your life. But the key word inside those calculations is gross income, and that word hides one of the most important realities of personal finance. Gross income is not the money you actually spend in everyday life. A household earning $120,000 per year might appear financially comfortable when those ratios are applied during mortgage approval. However, a large portion of that income disappears before it ever reaches the family's bank account. Federal taxes remove a significant percentage. State taxes may remove even more depending on where the household lives. Payroll deductions quietly reduce the remaining amount even further. Health insurance premiums subtract another portion. Retirement contributions lower the number again, and suddenly the take-home income that actually fund's daily life looks dramatically smaller than the salary listed on the mortgage application. The payment that appeared comfortable on paper now begins competing with real-life expenses that were never part of the lender's calculation. Groceries still need to be purchased every week. Transportation still requires fuel, maintenance, and insurance. Utilities fluctuate depending on the season. Medical costs occasionally appear. Without warning, daily life continues moving forward whether the mortgage payment feels comfortable or not. This is why mortgage approval should never be treated as a target when choosing a home. It should always be treated as a ceiling that represents the upper boundary of what a lender is willing to risk. Just because a bank says you can afford a certain house does not mean that decision supports the long-term growth of your financial life. And once the home purchase is complete, another layer of financial reality begins appearing that many buyers underestimate. During the excitement of buying the property, the mortgage payment itself is only the most visible piece of the total cost of owning a home. Behind that payment exists an entire ecosystem of additional expenses that quietly accompany home ownership year after year. Property taxes must be paid every single year regardless of how your income changes. Homeowners insurance protects the property but adds another permanent cost to your budget. Utility bills tend to rise as the size of the home increases because larger spaces require more heating, cooling, and electricity. Furnishing a larger house often requires additional spending that continues long after the closing date. And then there is maintenance, the category that almost every homeowner underestimates before experiencing it firsthand. Real estate professionals often reference something called the 1% rule when estimating maintenance costs for a home. The idea is simple but powerful because it suggests that homeowners typically spend about 1% of the property's value each year maintaining the structure. For a $500,000 house, that translates into roughly $5,000 per year just to keep the home functioning properly. But maintenance rarely arrives as a predictable monthly bill the way a mortgage payment does. Instead, maintenance tends to appear suddenly and unexpectedly at the most inconvenient moments possible. A water heater stops working on a cold winter morning. A roof begins leaking during a heavy storm. An air conditioning system fails during the hottest week of summer. A plumbing issue emerges without warning and demands immediate attention. Each individual repair may be manageable on its own, but when the household budget is already stretched by housing costs, those irregular expenses can quickly create financial pressure that feels overwhelming. And while homeowners are managing those unpredictable expenses, another financial consequence quietly unfolds in the background. Without attracting much attention at first, every dollar committed to housing is a dollar that cannot be invested somewhere else. This concept is known as opportunity cost, and it becomes one of the most powerful forces shaping long-term wealth. Imagine the households beginning their financial journeys with nearly identical incomes and similar financial habits. Both families earn the same salaries. Both households begin saving and investing around the same time in life. Both families make responsible financial decisions most of the time. But one difference appears when they choose the homes they will live in. The first household purchases a $500,000 home because the lender approved the loan and the payment technically fits their income. The second household chooses a $350,000 home even though they could technically qualify for something more expensive. Because the second home costs less, the monthly housing expenses remain significantly lower. That difference might be roughly $800 each month depending on interest rates, taxes, and insurance costs. Instead of absorbing that extra money into lifestyle spending, the second household decides to invest it consistently every single month. Month after month, that $800 quietly flows into retirement accounts or diversified index funds. There is no dramatic investment strategy involved. There is no attempt to time the market perfectly. There are no high-risk financial bets. There is simply a steady habit of investing the difference created by choosing a less expensive home. If those investments grow at an average annual return of around 7%, the long-term result becomes surprisingly powerful. After 20 years, those monthly contributions grow to roughly $420 in additional investments. That wealth did not come from extraordinary stock picking. It did not come from luck. It came from one structural decision made years earlier about housing costs. And this is why the question you ask before buying a home can quietly determine the trajectory of your financial life for decades. Because the smartest housing decision is rarely about stretching to afford the most expensive property a bank will approve. The smartest housing decision is about choosing a home that allows the rest of your financial life to continue growing year after year without constant financial pressure. And sometimes the most powerful wealth-building strategy is surprisingly simple. Choose the house that leaves room for everything else in your financial life to keep expanding. Now imagine what happens quietly over the years when that difference between stretching for the maximum house and choosing a financially comfortable house begins compounding through everyday financial decisions that most people barely notice at the time. Because the moment someone buys a home that consumes a large portion of their income, something subtle begins changing in the rhythm of their financial life. Even if their salary continues increasing over time, instead of raises creating financial freedom, those raises often disappear into expenses that naturally expand around the larger home and the lifestyle that tends to follow it. The larger house encourages larger furniture purchases, larger maintenance costs, larger utility bills, and a constant stream of small upgrades that feel reasonable individually but accumulate into a much larger financial footprint over the years. What began as a proud milestone of owning a beautiful home slowly becomes the center of gravity for the household budget, quietly pulling more and more money toward itself every single month. At first, this may not feel like a problem because the payments are still manageable, and life continues normally without obvious financial stress. But financial pressure rarely arrives dramatically in the beginning, because it tends to appear gradually through a series of small compromises that slowly reshape the household's financial priorities. The first compromise often appears when retirement contributions become slightly smaller, because the monthly cash flow feels tighter than expected. Then emergency savings grow more slowly because the mortgage payment and property taxes already absorb such a large portion of income. Soon after that, investment contributions become inconsistent because unexpected expenses seem to appear more frequently than anticipated. Over time, the household begins noticing that financial progress feels slower than it once did, even though their income may be higher than it was years earlier. This is one of the most powerful financial side effects of expensive housing, because it quietly reduces the consistency of long-term investing. And consistency, more than almost any other factor in personal finance, determines whether wealth accumulates steadily over time. Research from major investment firms has repeatedly shown that the most reliable predictor of long-term wealth is not market timing or investment genius, but simply the habit of contributing money consistently over many years. When housing costs remain moderate, that habit becomes easy to maintain because extra income naturally flows toward investments and savings. But when housing costs dominate the household budget, every financial contribution begins competing with fixed obligations that cannot easily be reduced. Mortgage payments must be made regardless of whether income fluctuates. Property taxes must still be paid even during financially difficult years. Insurance premiums continue arriving on schedule no matter what else is happening financially. Maintenance issues cannot be postponed indefinitely because the physical structure of the house requires ongoing care. All of these obligations combine into a financial environment where flexibility becomes increasingly rare, and flexibility is one of the most valuable qualities a household can have when navigating decades of economic uncertainty. Life rarely moves forward in a perfectly predictable financial pattern because careers evolve, industries change, and unexpected opportunities sometimes appear when they are least expected. A household with moderate housing costs can adapt to those changes far more easily than a household whose income is already committed to the maximum mortgage they could qualify for years earlier. If a new career opportunity appears in another city, financial flexibility makes relocation easier. If someone decides to pursue additional education or start a business, a manageable mortgage allows more room to take calculated risks. If an economic downturn temporarily reduces income, a moderate housing cost can provide the breathing room necessary to navigate the situation without panic. But when housing expenses consume a large share of income, every unexpected event begins feeling like a financial emergency. This is where the phrase house rich and cash poor becomes extremely relevant in real life. A household may technically own a valuable property that increases their net worth on paper, yet still feel financially constrained in their daily lives. Their balance sheet may appear strong because their home equity is growing slowly each year. However, their bank account may remain relatively small because so much income flows toward housing-related expenses. From the outside, the situation often looks like financial success, because the home itself represents wealth and stability. From the inside, it can feel like constant financial pressure, because liquidity is limited and financial choices become restricted. Liquidity simply means having access to money that can be used when needed without selling major assets or borrowing at high interest rates. And liquidity plays an essential role in financial resilience, because it allows households to respond quickly when unexpected events occur. A household with strong liquidity can handle emergencies, pursue opportunities, and invest consistently even during uncertain periods. A household with limited liquidity often relies on credit cards or loans when unexpected costs appear, which slowly introduces additional debt into their financial lives. This cycle is surprisingly common because expensive housing naturally reduces the amount of cash that remains available each month. And while homeowners often assume that rising home values will justify stretching their finances, the reality of real estate appreciation is frequently misunderstood. Homes do tend to increase in value over long periods of time, but historical data shows that the growth rate is typically more modest than many people assume. Long-term research analyzing housing prices across more than a century of economic cycles suggests that real estate values in the United States have historically increased roughly 1% above inflation each year. This represents stable and reliable growth, but it is far from the explosive wealth creation that some people expect when they stretch their finances to purchase a larger home. By comparison, diversified stock market investments have historically produced average returns closer to 7% per year after inflation over very long periods of time. This difference in growth rates highlights an important distinction between a home and an investment portfolio. A home is primarily a place to live and enjoy life rather than the primary engine that builds long-term wealth. The true financial power of a home often comes from stability and lifestyle benefits, rather than extraordinary investment returns. When homeowners recognize this distinction, they often begin asking a more useful question during the home buying process. Instead of asking what is the most expensive house they can qualify for, they begin asking what housing cost allows the rest of their financial life to remain healthy and flexible. Some households approach this question using a guideline that housing expenses should remain below 25% of take-home income, rather than gross income. Others focus on maintaining enough financial space to consistently support three core priorities. The first priority is contributing steadily to retirement accounts or long-term investment portfolios. The second priority is maintaining a well-funded emergency reserve, capable of covering several months of living expenses. The third priority is preserving enough monthly cash flow to handle unexpected costs without financial stress. When housing costs remain moderate, these priorities become easier to maintain even during unpredictable financial periods. The result may be a smaller house than the bank was willing to approve, but the trade-off often produces something far more valuable than additional square footage. It produces financial breathing room that allows a household to keep moving forward, rather than feeling permanently constrained. Over time, that breathing room begins creating opportunities that expensive housing quietly eliminates. Additional income from raises or promotions can flow toward investments rather than disappearing into larger mortgage payments. Unexpected financial opportunities can be pursued because the household has the flexibility to adapt quickly. Investment contributions remain consistent even during periods when expenses temporarily increase, and slowly, almost invisibly at first, the household's financial trajectory begins rising higher than it otherwise would have. This is the quiet power of structural financial decisions because the largest differences in wealth rarely come from dramatic moments of financial brilliance. Instead, they often come from simple decisions that make it easier to maintain healthy habits year after year. Choosing housing that supports consistent saving and investing is one of the most powerful examples of this principle in action. Over decades, those steady contributions accumulate, compound, and eventually create a level of financial independence that would have been difficult to achieve if housing costs had consumed too much of the household's income. And this brings us back to the central question that quietly determines the financial outcome of one of life's biggest purchases. The real question is not whether you can technically afford a $500,000 house, according to the lender's formulas. The real question is whether that house allows the rest of your financial life to grow without constant pressure, because long-term wealth rarely comes from stretching to own the biggest house possible. It usually comes from maintaining flexibility, investing consistently, and allowing time and compounding to do the heavy lifting over decades. And sometimes the smartest financial decision is surprisingly simple. Even if it feels less exciting in the moment, choose the house that leaves room for everything else in your financial life to keep growing. And when you truly begin to understand how powerful that single housing decision can become over decades, you start realizing that the size of the mortgage you choose today quietly shapes hundreds of financial choices you will make in the future, because every single month your income rises and immediately begins flowing toward fixed obligations. And the largest of those obligations for most households is the home they decided to purchase years earlier. If that obligation was designed carefully with flexibility in mind, the remaining money each month becomes fuel for financial growth through investing, saving, and building opportunities that did not exist before. But if that obligation was stretched to the maximum level allowed by a lender, the remaining money each month often feels like it disappears before meaningful progress can occur. This is why experienced investors and financially independent individuals often speak about housing decisions with a level of caution that surprises many first-time homebuyers. They understand that the true cost of expensive housing is not only the mortgage payment itself, but also the years of investment growth that may never occur. If too much income is directed toward the home, every dollar has a job in a household's financial system. And when too many of those dollars are permanently assigned to housing expenses, fewer dollars remain available to participate in the compounding process that builds wealth over time. Compounding is powerful precisely because it rewards consistency and patience, allowing small contributions to transform to significant financial resources across decades. But compounding requires one simple ingredient that expensive housing often removes from the equation, and that ingredient is consistent excess cash flow. Excess cash flow is the quiet hero of financial independence because it gives households the ability to invest regularly without constantly worrying about whether they can afford to do so. When housing costs are moderate, excess cash flow appears naturally whenever income increases, which means raises, bonuses, and promotions can quickly accelerate investment growth. When housing costs are high, those same income increases often disappear into the structure of the household budget, without producing the same long-term financial momentum. This difference may seem small at first, because the lifestyle of both households might appear similar during the early years. After buying a home, both families still go to work, both families pay their bills, and both families continue living their lives in houses that provide comfort and stability. But beneath the surface, something very different is happening financially as the years begin to pass. One household continues building financial momentum because investments are growing steadily alongside their income. The other household experiences slower financial growth because a larger portion of income remains tied to the house itself. After 10 years, the difference might begin to feel noticeable but still manageable. After 20 years, the difference can become dramatic because the compounding effect of consistent investing begins accelerating rapidly. After 30 years, the financial trajectories of the two households may look almost unrecognizable compared to one another, even though both families earn similar incomes throughout their careers. This is the hidden influence of structural financial decisions because they shape the conditions under which all future financial choices are made. Housing is one of the most powerful structural decisions because it determines how much financial energy remains available for everything else in life. And when people begin looking at housing through this broader financial lens, they often start asking questions that rarely appear in traditional real estate conversations. Instead of focusing only on square footage, granite countertops, or the prestige of a particular neighborhood, they begin evaluating how the home fits into the long-term architecture of their financial life.